Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
Volatility is not done. Now, I'm not talking about for a bounce. I'm not talking about like I set that up just the day before yesterday going, okay, here's what I'm looking for, a little bounce. And then yesterday, here's what I'm looking for, a cold CPI. So here's another little bounce. But that's just for a day. That's like an overnight boom. But big picture, I'm talking about when is it safe to close hedges and buy again? That's what I look for, is that more durable swing long. And by the way, when we had the August 5th convexity rally, it was wow. It was huge. It was ginormous. There's nothing like it. It's VIX 65 pre-market, and then the buying just started and didn't stop. This is different. This is very broken. Underneath the market, we can have some nice little bounces, but we're in a huge topping pattern now. So at the time that happened in August, we were still trending up. So it was very easy for a convexity rally. Honestly, we also had FX currency as the trigger. FX was yen carry trade unwind. You know, kind of see where positioning was for that particular asset. We have everything going on right now. We have the dollar dumping with a larger than 4 standard deviation move, which in the long term is exactly what the administration wants, but in the short term is extremely disruptive, and it's pushing foreign investors out. It's shaking up regular investors. There's a lot of volatility in a very short period of time, as you can see intraday, I've shown. And as you have talked about, as far as, you know, this is historic. The point is we're actually starting to roll over with the macro tailwinds to roll over, with the fundamental tailwinds to roll over. It used to be AI or quantum or whatever, and now that's going, well, actually China is eating our lunch. So we really have to be more realistic. So the point is we have lost a lot of the story stocks. We have lost the macro tailwinds. We have a new administration that needs to do the, you know, rip the Band-Aid off kind of thing and make it very painful to hopefully have pleasure later. So there is going to be these reflexive, not convexity, but I think more reflexive bounces into resistance. And we're going to have this process all Q2 unless we just dump down and then really it's just way too yummy. But right now buyers have stepped away. All of my intermarket analysis is still basing, which means it's oversold, which means buyers have not stepped in. They have stepped away. When you were talking about breadth, this is S&P percentage of stocks above their 200-day. Back in August, when we had the yen carry trade unwind and NASDAQ fell 15%, semis fell 25%, NVIDIA fell 35%, we still did not pierce 65%. What are we right now? We're down in the 45 handle. Much worse breadth than we were after the yen carry trade. I could go on and show you that this is still a risk. One other thing that folks aren't really keyed in on is because credit spreads have been so tame, and that's one of the reasons why we have this outperformance until COVID. Speaking of COVID, for all of 19 and into and before COVID, credit spreads were also descending until COVID, and then obviously blew out. We have been in this very, very controlled downtrend as well for tight credit spreads. Credit leads equities. We don't need much as a trigger to actually get back above that trend line and push higher. So I still think the risk of a macro event risk is actually pretty evident. And to answer your question, the policies that are more macro driven as a way to decouple from the dependency on China, to decouple from the war machine that is really a lot of money laundering to Europe, although Trump is still very pro-war as it relates to Iran. So we're just trading one for another potentially. But the policies as it relates to getting manufacturing back to the US is going to be short-term, very destructive for our currency. And that's good as it relates to being able to have an advantage for US exporters, but it's very bad as it relates to the structure of the money that has flown into the US because of our strong dollar. So we're kind of trying to thread the needle of what is going to excite to keep money here. And right now they're disincentivizing. They're actually wanting money to go home. So less demand of US dollars. It doesn't mean we're going to dump precipitously, but I will warn, and something that Jeffrey has been on often, and this is our amazing classical economics macroeconomics advisor, Jeffrey Fouret, who is very much entrenched in what happens under fiscal dominance, what happens with trade deficits, what happens with these policies that are dollar bearish, oil bearish, yield bearish. The problem is, if they do not fix the deficit, we start to increase the rate of interest that is charged on our rising debt. We get another 2 basis points higher, let's say 6%, which is a Sem Carson and some others have said we're going to 6%, we're going to 6%. That will destroy the US. It will destroy the US. You get 30% of interest on revenues and the currency will plummet. That's only at 6% for the 10-year. That's a big deal. The market's starting to kind of, hey, okay, money's going to go home. That's going to hopefully help exporters. That's not the point. If they don't get control of the deficit and this interest on revenues equals 30%, in other words, the 10-year yield goes from 4% to 5% to 6%, the currency in past has collapsed in other occasions over history. That has always been kind of the Bitcoin anti-American, hedge, if you will, right? They're worried about the devaluing dollar. By the way, Bitcoin will be also useless. Crypto will be gone. But the point is, that is very much the focus of falling dollar is bullish until it's extremely bearish. And what happens also in the bond market is when the currency fails, US treasuries are backstopping the value of the dollar. The dollar is used to pay the military, not Bitcoin. So the military is actually what has held our reserve status globally. Trump is trying to dismantle that as well on purposes of reducing war spending. That's actually very good. That actually can help deflate the inflationary impacts that we've had, but not if the deficit keeps rising. All bets are off. So the only way that we're going to save, we're going to be saved is if in fact they get control of this fiscal spending and specifically restructure and specifically not just cut, out the Doge, the people that are in government, but the programs that are the Congress, the power of the pen needs to actually be controlled. Otherwise, all this talk that we have on a weekly basis about what stocks to trade, oh yeah, we're short this, we're long that, this is a great option structure. Honestly, none of it will matter because the dollar will fall with bonds. The treasury market will have a sovereign debt default, and that's within 200 basis points of where we are. That's what matters.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.